Have you ever wondered how some wealthy families transfer millions of dollars to their children while minimizing gift and estate taxes? One of the most powerful strategies for doing that is called a grantor retained annuity trust, or GRAT. A GRAT is an estate planning tool that allows future asset growth to pass to beneficiaries in a tax-efficient way while allowing the original owner to continue receiving payments from the trust for a set period of time. As of 2026, GRATs remain one of the most widely used wealth transfer strategies for individuals with large estates and assets expected to appreciate significantly. Now let's take a look at exactly how it works. The grantor transfers assets into an irrevocable trust. These may include stocks, real estate, business interests, or other investments with strong growth potential. Once the trust is funded, the grantor receives fixed annuity payments for a predetermined number of years. Those payments are calculated using the value of the assets, the trust term, and an IRS interest rate known as the Section 7520 rate. Think of that rate as the hurdle the assets must beat. If the trust assets grow faster than the IRS assumes, the excess appreciation may pass to beneficiaries with little or no additional gift tax. For example, if a GRAT is funded with $5 million of assets and those assets substantially outperform the IRS hurdle rate, much of that excess growth can eventually transfer to heirs outside the grantor's taxable estate. One of the most common structures is called a zeroed-out GRAT. This design minimizes the taxable gift when the trust is created. Most of the original value is returned to the grantor through annuity payments, while excess growth passes to beneficiaries. Now let's talk about the advantages. The biggest benefit is estate tax reduction. Future appreciation can be removed from the grantor's taxable estate, potentially saving substantial estate taxes for high net worth families. A GRAT is also highly efficient for transferring wealth. If assets perform well, beneficiaries may receive significant value with minimal gift tax consequences. This strategy is especially attractive for assets expected to grow rapidly, such as concentrated stock positions, privately held businesses, or valuable real estate holdings. Another advantage is that the grantor continues receiving annuity payments throughout the trust term, providing ongoing cash flow rather than giving assets away outright. But GRATs are not without risk. First, the trust is irrevocable. Once assets are transferred, the grantor generally cannot reverse the transaction. Second, the strategy depends heavily on investment performance. If the assets fail to outperform the IRS hurdle rate, the tax benefits may be limited or non-existent. There is also mortality risk. If the grantor dies before the trust term ends, some or all of the trust assets may be included in the taxable estate, reducing the intended benefit. And finally, GRATs require careful administration. Accurate valuations, legal drafting, tax compliance, and ongoing management all contribute to the complexity and cost. Professional fees often start at several $1,000s and can be significantly higher for larger estates. So is a GRAT right for everyone? Actually, it's not necessarily the right move for everyone. GRATs tend to work best for individuals with substantial wealth, assets expected to appreciate significantly, and a desire to transfer wealth to future generations as efficiently as possible. For smaller estates, the cost and complexity may outweigh the benefits. Because ultimately, a GRAT is not just about reducing taxes, it's about transferring future growth, preserving family wealth, and creating a more efficient path to the next generation. And the real question is this: if your investments grow dramatically over the next decade, do you want that future growth remaining inside your taxable estate or moving to your heirs with as little tax friction as possible?